watching another episode of Money Fundies. My name is Matt Stearns and you're here at Millennial Money Management. If you missed our last episode, we talked about how to effectively pay yourself first and set up a functioning personal budget, so please check that out. Today we're going to stay on the personal finance topic and talk about credit scores and just how impactful they can be to your future financial situation, and also how credit scores are calculated and how you can actively manage them, okay? So before we start, I think it's really important that I make a point about actively monitoring your credit score. So we've heard about the apps that are available online that you can check your credit score, things like Credit Karma, that will allow you to check your score as much as you want and not have any adverse effects on your credit score. That's a great tool, but I also recommend getting a credit report from one of the 3 credit reporting bureaus, and you're legally allowed to get one every year from each of them, and they offer a really detailed look into your credit score, how it's being calculated, and the things that are affecting it. Okay, so definitely be actively monitoring your credit score, and I highly advise getting one of these credit reports because for someone like me, it gives me a lot of insight into your particular credit situation. So that would be the first point. After that, we have to understand exactly how credit score is being calculated. So I'm going to go over the 6 things that these credit reporting bureaus look at and ways that you can actively, manage or improve them, okay? So the first one, and this is the most important, that is your percentage of payments on time. Okay, so lenders look at this as a way to check if you're being consistent and timely in your payment manner, okay? And this is the highest impact on your score, all right? And it's also something that would have the highest negative impact if you were to miss a payment, okay? So to give you an idea, a great or an excellent score in this category would be 100% on-time payments, okay? But a really poor score would be only making 90% of your payments. So you only have to miss 1 out of 10 payments, and you're talking about a huge impact in the negative direction on your credit score, okay? So rule number 1 is to make sure you always pay and make your payments on time, okay? And the best way to do this is to set up an automatic payment system on your credit cards or your loans, whatever it may be, so you know that they're being taken care of and you don't have to think about it or make the conscious decision every month, because like I said, if you forget one time, it's going to dramatically affect your credit score, okay? The next important factor that is issued into this is the percentage of credit that you're using, and in addition to that, the amount of total credit you have available. So total credit would be all of your credit lines added together. So let's say you have 2 credit cards and they each have a $10,000 credit maximum, then you would have $20,000 of available credit. Then they look at what percentage of that credit you're actually utilizing, okay? And lenders want to see that you are effectively and responsibly using credit, but not to a great extent. So you're being reasonable in the amount of credit that you're utilizing. So reasonable would be anything under 10%, and then excessive would be anything over 50%. So if you had $12,000 between your 2 credit cards, that would negatively impact your credit score. And that's one of the examples where you could actively improve your credit score almost in a matter of weeks. Typically it takes a couple months for these credit bureaus to communicate with each other, but that's one thing that you can do to improve your credit score almost instantaneously, okay? The next important factor is the age of your oldest account. This confuses some people because they have questions about what actually represents their oldest account, and these credit reports that I advise you to get from these bureaus will tell you what account is being calculated into this. So check and know what account represents your oldest account, whether it's a credit card you opened several years ago or your student loan payments, whatever it may be. But in the event of a credit card, for example, if that represents your oldest account being open and you didn't open up another account for a few years after that, it would be recommendable to leave that credit card open if there is no fee for the remainder of your life, okay? Because that's just providing you a lot of benefit to your credit score, and you don't want to take that away. So that's one thing to consider when we talk about opening or closing credit cards, okay? And then the last 2 points are really about inquiries and new accounts, okay? And the credit bureaus really only care about what you've done in the past 2 years. So they're looking at things like how many times has he applied for a new loan, whether it's a mortgage or a car loan, and how many new accounts did he actually open, okay? So that's part of the conversation you have about, will it negatively impact, my credit if I get open up a new credit card? And there's a couple different things to factor into that, of course, because some good things are happening in that situation as well. So in the next episode, I'm going to be going over more about credit cards and how they can help our credit score and strategies to use them responsibly. But before I go, I want to give you some benchmarks about what's credit scores you need for certain things and modern day examples. So right now, a lot of my clients come in and they want to refinance student loans. In this particular situation, the cutoff is typically around a 650 score. So if you're below that, we have to figure out a way to manage your score in the positive direction. Also, if you're looking to buy a mortgage and you're a first-time home buyer, perhaps with an FHA loan, it can be as low as 580, but should be really above the 600 range. And then credit cards are about the same number, right around 600, okay? But let me give you an example of what improving your credit score could mean by improving it 150 points. Let's say you go from 620 to 770, okay? On a 30-year mortgage on a house that costs $150,000, by improving your credit score 150 points, you would reduce your interest rate on that 30-year mortgage by 1.5%. And on that house and on all your payments over those 30 years, you would save $50,000. Okay, so that is how important it can be for your financial future to get on top of your credit score. And it has huge implications. It can decide whether or not you can refinance your student loans. And all of these things are factoring in your credit score for the interest rate that you get, whether it's a credit card or your mortgage, whatever it may be. So it's going to be vitally important to you for the rest of your life. So get on top of it now, monitor it. As I always say, set up these automatic processes to facilitate the transactions for you. And if you do that, you should be good to go. But realize it's something that you can manage, okay? And just having a little bit of understanding of what I went over today could help you improve your score, almost immediately. So that's all I have for you today. Thanks for tuning in. Please subscribe, like, comment. Hit me up if you guys have anything else you'd like me to talk about. And of course, we'll see you next time. Thank you.